Futures Radio Show, sponsored by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world effectively manage risk. For access to free educational tools and resources for the active individual trader, please visit activetrader.cmegroup.com.
Every day, traders and investors dive in to tackle the ever-changing markets to find opportunity. Futures Radio Show is your number one source for answers to the questions that all market participants want to ask. Veteran futures trader Anthony Crudele sits down with the most influential leaders and top traders in the industry. Now, here's your host, Anthony Crudele.
Hey everybody, thanks for tuning in for this episode with Danielle DiMartino Booth. Remember, new shows are posted every Monday and Thursday. You can subscribe to our show on iTunes and YouTube. If you're enjoying the show, please leave a review on iTunes. Before I play today's interview for you, I want to give a shout out to the great sponsors of Futures Radio Show: CME Group, Trading Technologies, RJO Futures, and Top Step Trader. To learn more about these sponsors and the important things they are doing for futures traders, be sure to click on their logos on our website. Today, I spoke with Danielle DiMartino Booth, CEO of Quill Intelligence. In my opinion, Danielle is one of the best when it comes to analyzing the Fed. In today's episode, Danielle and I chatted about why she believes equities are ignoring the Fed. She gives us her thoughts on Fed Chair Powell, why Danielle thinks that bonds and treasuries are paying attention to the Fed, but she doesn't see rates going much higher than they are right now. Danielle explains why she thinks the dollar should be stronger and what that is signaling to global markets. Finally, we talked about the U.S. debt, gold, and a little bit of Bitcoin. Without further ado, let me take you right to that interview with Danielle. Danielle, thanks for joining me.
Happy to be here today.
Well, it's great to have you here today, Danielle. You do a lot of media, great coverage on the Fed. And I think that everyone listening knows what you think about Powell, the Fed, and the latest meeting. So I want to take a different approach today. I'm a trader, and a vast majority of my audience are traders. Most of us are active traders. And we just try to read the tea leaves. We keep things very simple. I'm speaking for myself, of course. Other traders might want to know a little bit more in details of what's going on with the Fed. But I think for most of us, we try to build a theme around what's happening with the Fed and see if it's impacting the markets in a traditional sense, which nothing traditional about these markets anymore, or is the Fed not having an impact on the markets that we're trading? So today I specifically want to talk about a handful or so of markets, get your thoughts on what the current Fed policy should mean for these markets and if it's actually impacting them. So if you're game for that, that's what we're going to do today.
Let's go.
All right, cool. Let's start with equities.
I think right now that the equity market is keying off of everything and anything but the Fed. David Kostin over at Goldman Sachs put a great report out last week. It basically said 86% of companies are going to be in blackout by the time October the 6th rolls around. That could be problematic because the way I look at the world is liquidity, and liquidity is fungible. So markets don't care what the source of liquidity as long as it is there. And, I'm sure all of you have been looking at these charts that show that the MSCI ex United States has tanked this year, even though it's recovered a little bit off of its lows, while our markets have continued to make new highs. For me, that's just a pure mirror reflection of liquidity and the share buybacks that we've had in this country that the rest of the world has not benefited from, not Fed policy.
I agree with you about the buybacks. It's been huge. Getting back to the Fed, though, what headline coming from the Fed should I be watching for that would grab the attention back of the equity markets?
I think that the equity market is going to be fairly agnostic unless they start to see signs from the Fed, because according to Jay Powell's most recent press conference, and the beauty of Jay Powell is, for traders at least, they can almost disregard all of their Fed speak, right? You've got somebody who's going to be speaking at every single Federal Reserve meeting starting in January, basically starting in December. Starting in December, you can disregard all Fed speak. And what he said because he's going to have a press conference after every single FOMC meeting, which is a huge game changer for market participants, for traders. But what he said at his most recent press conference is, we're not going to raise interest rates more than every quarter the way we've been doing it. We're not going to get off of gradual, if you will, unless the inflation data suggests that we should. And what we know is from listening to CFO surveys, and they're the ones who are making budgets, right? They're the ones who are getting squeezed or not squeezed their margins. They're the ones who are having to bring on new labor at higher costs. They think that labor costs are rising at a 4.8% rate over the next 12 months. If their data even begin to catch up with what the wage data that we see on non-farm payroll Friday is, if that gap even begins to close, then I think that will put Jay Powell into an active mode at meetings that traders haven't had to pay attention for since Bernanke was in office, meaning January.
Are you happy with this approach from Powell?
Well, I think it's very mature. It's nice to have an adult at the Fed for once. It's not that I'm running his fan club. He's just of the attitude that if the data change, then so will policy. I mean, he basically said that the dot plots at his most recent press conference were quote unquote interesting. That to me, as somebody who's been in the markets for 20 years, as he was, simply means useless. So it's
no
like,
doubt.
Let's move on and make monetary policy for adults. And if the facts change, Jay Powell's going to change with them. And I think that that's a lot easier for traders to follow.
I would agree. As a trader, I am much happier with him at the helm than several of the previous ones. I could tell you that right now. Let's move on.
What's not to like?
Yeah, right. Let's talk about bonds and treasuries.
Okay. They're paying attention to the Fed. They're not benefiting from share buybacks at all. They're benefiting from companies not defaulting. They're benefiting from the liquidity tide, if you will. But we still have the difference between the two big benchmarks, right? The 2-year and the 10-year Treasury. That's still sitting at 25 basis points at a quarter. So what it's telling you is that markets are precariously close to hitting the fear panic button. Because it's not so much the fact that the yield curve is flat or steep. What traders care about is when and if it inverts, because that hits the fear button. That is when bond markets finally begin to communicate loudly and clearly with the stock market. And what the Treasury market is telling you right now, as the short end continues to tick up, it's that the long-term prospects for the economy are not being reflected as strongly as a lot of the talking heads on bubble vision would have you believe. They'll tell you that the Fed is only raising interest rates because the economy is so strong. Well, with all due deference, the bond market disagrees with that assessment.
So what I'm hearing from you is that you don't think that rates are going to be going up much from here at all. You think they're probably stuck here for now. And, it takes me back to the technical side of things. When I look at the 10-year, to me, they're going to keep breaking. I think rates are going up. So I don't know. I mean, am I wrong for saying that you think that rates are stuck here? They're not going anywhere?
I speak to a lot of rates traders. And they've been staring at the same channel that you've been staring at, and they think this 10-year is poised to go to 3.4, whatever. I can't see it. I look at the market through a fundamental prism, and the fact that we've got the 30-year mortgage at 5%, and this is enough to slow the housing market, and the economy keys off of the housing market, and we've seen the home building stocks get slaughtered. It's telling you that households are extremely sensitive to rates, more than they should be if we're looking at a piece of paper going, but that's still really a low mortgage rate. You know what? You're right. It is really a low mortgage rate. But home prices have gone up so much, and affordability is so stretched that it doesn't take very much to shut down this housing market, and that's what we're seeing.
Okay, let's talk about a scenario here. You think that rates are stuck here. I think rates are going higher. Some of the bond and treasury traders that you speak to also think that rates could uptick from here in the 10-year. Let's say that happens. We get a 3.5% in the 10-year. I think that's very possible. I think even higher is possible. What happens then? What does the Fed do if we see that in the 10-year?
Well, I think the Fed then has to start taking into account things like what is happening overseas. Because if you're talking about a 3.5 or a 4% handle on the benchmark 10-year Treasury, then you have to start whipping out a laundry list of countries that we've just lost. Whoop, there went another country. I mean, that's how sensitive other countries are, because I don't think that the dollar is as weak as it has been if you start to see a breakout to the upside in 10-year Treasury yields. And the only reason that we've seen such nicely behaved global behavior since the 10-year broke above and held 3%, now we're at whatever, 306, 307. But the only reason that we've seen such well-behaved markets outside of the United States is because the dollar's been weak in the face of rates rising. That is not normally the way things work with markets, right? You see the dollar strengthening, you look at the mirror image and you see rates rising. We don't have that right now because I think some of the rest of the world is beginning to have anxiety fits about the size of our deficit and it having to be financed going forward. But if you see a 3.5 or 4% handle on the 10%, you're going to have upside in the dollar and you're going to have other countries go. And that's going to bring the Fed back to having to take into consideration international markets and the effect that policy has outside of our borders.
Earlier, you said that the equity markets were looking at everything and anything but the Fed. I have to assume that a 3.5% in the 10-year indicates that equities will be looking back at the Fed again.
Well, of course it does. Now, look, we've started to see outflows from high yield bond funds. This is the first time we've even seen a minor chink in the armor. In fact, I'm writing about this week. The high yield bond market has been a safe haven in the current, call it past 12 months of resumed volatility. Money has come flooding out of investment grade counterintuitively, but it has stayed locked tight in high yield. I would expect to see that dynamic change if you were to see the 10-year rise up to a certain level, because markets right now are on methadone because the assumption has always been, yes, there's a wall of maturity. Yes, there are bonds that have to be refinanced. Yes, the credit is absolutely crappy. Without a doubt, we completely agree that these companies should be out of business. But as long as interest rates are well behaved, they will get refinanced. If that assumption goes away, then you will start to have some very upset high yield issuers, and that will bleed into the equity market.
Hey everyone, I hope you're enjoying the show so far, but I want to pause and thank one of our sponsors, Trading Technologies. I started using TT in the year 2000, and I love it. It is by far the best trading platform I have ever used, and I've tried a lot of them. With TT, you can trade the global markets from virtually anywhere in the world. They are the world's fastest commercially available futures trading platform. I highly suggest you go try out TT, especially because you can try it for free. Just go to tryttnow.com and set up your account. No arguments from me there. The next market I wanted to talk about was the dollar. You've actually already touched base on that a little bit. Sounds to me like you think that the dollar should be higher than it is right now.
The dollar should be stronger unless the dollar is sniffing out the fact that higher interest rates and the Fed following wage inflation, which the Fed is going to do. The Fed will follow the unemployment rate. The Fed will follow wage inflation. Unfortunately, these are the most lagging of all economic indicators. If traders are wanting to follow the Fed, they need to figure out what the economic indicator is that represents the caboose on the train. And the caboose on the train is wage inflation and the unemployment rate. They're the last to break when an economy turns. So if that's the case, then the dollar could potentially be sniffing out the Fed going too far, putting the U.S. economy into recession at the same time U.S. deficits are going through the roof, both of which are dollar weak.
Okay, so another scenario for you. Let's say that the dollar starts to really get legs and rip higher from here, and that happens before the 10-year were to get to 3.5%. What would that mean to you?
Well, a stronger dollar taking the rest of the world down has not been of interest at all to our stock market so far this year. Again, it's pretty easy to disregard the fact that quantitative tightening is in the highest gear ever, and all of this liquidity is coming out of the system from the Bank of Japan and the European Central Bank slowing down their purchases to the extent they have. It's really easy to ignore that in the face of $850 billion in share buybacks, which wipes clean any other year in the history of the United States going back as far as we've had share buybacks. So it's from our perspective, we've been agnostic to a strong dollar taking down other countries because we've had an idiosyncratic boost to our market in the form of this is our liquidity, not yours. We've got it, you don't. So as long as that holds, we're fine. Otherwise, if you were to see finally some contagion effect of other countries are going, is this eventually going to affect the United States, especially if anything happens in the European bond market, then I think it's all bets are off. We're going to have to wait and see how long after this next coming blackout window comes and goes for the corporate earnings cycle. We're going to have to wait and see how much fuel the rest of these share buybacks can put into the market. And we see that reflected in the narrowing breadth of outperformers within the stock market. That is simply a reflection of where the liquidity is going. The liquidity is going to the biggest market cap stocks, period.
Unprecedented times. What can I say? Sound like anything anyone's ever seen before.
We had $2.1 trillion of global quantitative easing in 2017. As of October the 1st, somebody flipped a switch. Mathematically speaking, we've gone net negative for the year, liquidity-wise, central banking-wise, but not for the United States. We've got our buybacks.
Yeah.
Think of when you think of buybacks, think of backstop.
Last but not least, let's talk about gold. What does this all mean for gold?
I think gold stays well behaved until there is a hiccup. And when there is a hiccup and correlations begin to realign, when there is even a hint that Powell is nervous, and we haven't seen anything that shows that Powell's nervous. Powell's press conference started out with 4 words. This economy is strong. And as long as the attitude is thus, and as long as the anticipation is that we're going to continue raising interest rates and that the Fed funds rate is going to continue to tick up as per the Fed's game plan, potentially getting to the 3% neutral that Powell envisions, I think that gold stays well behaved and in bed in a coma. But the minute you start to see that this well-scripted game plan that the Fed has set out, that all of the markets are enjoying as much as they are, the minute you see maybe the yield curve invert, I think these are going to be points at which time the precious metals complex gets very interesting for investors. But you have to have a catalyst.
Do you think Bitcoin has found a role in this at all?
Oh, I'm not one of those stock jock types. I'm the wrong person to ask about Bitcoin. Remember, I spent almost a decade locked up in the prison called the Federal Reserve. But I do happen to think that Bitcoin is viewed as regulators and as politicians and as central bankers as a testing ground for what will eventually be sovereign cryptocurrencies. So I think Bitcoin has a very important role. I think it plays an important role. But until the dollar loses its reserve currency status, I really can't see it being some kind of a safe haven. I think that gold will wipe Bitcoin clean if there's true fear that hits the markets.
Yeah, I can't disagree with you, but it continues to be in the conversation more now. So it's just always something to keep an eye on.
It's fun to talk about, don't you know? There are more millennials than there are baby boomers in this country now. The baby boomers are dying off. So obviously we should talk about the sexy stuff, and the sexy stuff is Bitcoin. So we talk about it.
Yeah, absolutely. A couple things before I let you go. Remember when everybody used to talk about the debt? What do you think about that right now?
What?
Right?
The debt?
Yeah, right?
Oh, no. We don't need to worry about debt. Why worry about the debt? And again, that brings us back to the dollar discussion. The dollar is the currency markets are deeper and wiser than most people appreciate. They're bigger than any other market. And financing the debt of this country is getting to be very expensive very quickly. And it's not so much that somebody's going to wake up tomorrow and find religion and say, wow, we are really up to our eyeballs in debt. Shame on us. It's not so much that, but it is the math that's going to capture market's attention. And the interest costs in this country are going up, again, at a very fast pace. And that will start to get people's attention, especially after the midterms, when it appears that the situation in Washington is getting even worse.
What's your biggest concern of the Fed's current policy?
My biggest concern is a short-term and a long-term concern. and that is that the Fed does not have optionality. The Fed does not have the grace to allow the markets to correct, because if it does, it's going to take the public pension system down with it. So I would not want to be in Jay Powell's shoes, because even if you felt in his position that maybe a plain vanilla shallow recession would be cathartic for the economy and it would let us get to a cleaner place, and then we would take off and get to higher highs. Even a plain vanilla recession is going to be enough to have a serious pension crisis in this country, and that really does tie the Fed's hands, and that is what keeps me up at night more than anything else.
Let's leave on a positive note. What are you most optimistic about when it comes to the current and future Fed policy?
Well, again, we've got an adult in the Eccles building. I think that is really important, and I think a lot of the people he's building around him, a lot of the people on his team, I think are much more independent than what we've gotten used to. I think that even if the peanut butter does hit the fan, I still think we have a much more objective and independent and apolitical Fed than we've had in over 30 years since Paul Volcker was running the institution. And I think that in the long term, that is going to bode well for investors. I worry because, especially for equity investors, because I think that Jay Powell is going to let deeper losses accumulate in the equity markets before he even thinks about stepping in and pulling a Greenspan, Yellen, or Bernanke. But I think for the long-term greater good of the country, we're building up the best team we've had at the Federal Reserve in generations.
Well, that's great to hear, Danielle. Great stuff today. Where can people find you on Twitter, and give us a website to check out?
Sure. We have rolled out a brand new product. It's called the Daily Feather. It has taken Wall Street by storm. It's very popular. It does not give you individual trading ideas, but it does tell you where we are in the cycle and where we're headed. So it is very actionable in that sense. And you can sign up for that at quillintelligence.com. And always follow me on Twitter. It is never, ever boring, at DiMartino Booth.
No, it isn't. You're a great follow on Twitter, and in my opinion, the best when it comes to covering the Fed. Danielle, thank you so much for coming on Futures Radio Show.
Appreciate your time.
Thank you for listening to Futures Radio Show. If you have any questions or comments for myself or my guests, please visit futuresradioshow.com and sign up to be a premium member for free. If you enjoyed the show, don't forget to leave us a review on iTunes.